first video, I talked about how I think about accounting as scorekeeping, analogously to scorekeeping for baseball or basketball or football or whatever sport you like. Now I want to talk about what sorts of things we measure and communicate, and also how we measure and communicate. So what sorts of things do we measure and communicate? Well, I mentioned in my previous video the idea of business transactions, types of things that businesses do. Accountants generally break business transactions down into three types of activities. The most common one that we have experience with is what are called operating activities. These are the things we think about a business doing. So it's selling things to customers, buying the things to sell, we call that inventory, buying the inventory that we sell to customers, employing people, so the wages and the salaries that we pay to our people are operating activities, renting locations, so a store rents a space or a manufacturing facility rents a large amount of space to do its work in, and owning things like the inventory and supplies that are used in the work and that sort of thing. So we can generally think of these as the common business operating activities, and this is one type of transaction that accounting accounts for. Now, in order for a business to do the operating activities, it has to have stuff to work with. It has to have often buildings, has to have equipment, has to have computers. Depending on the type of company it is, it has to have intangible, non-physical things. It could have brand equity. If you think about the value of the Coca-Cola name, would anybody buy sugary water if it didn't have Coca-Cola on it? Well, certainly many fewer people would buy sugary water if it didn't say Coca-Cola on the bottle. So the name brand of Coca-Cola has some value. There are lots of these types of things that are intangible that have value. Well, in order for the business to undertake operating activities, it must undertake what are called investing activities. And investing activities are the purchase of long-term resources. In other words, resources that will be useful to the business for a long period of time, generally defined as more than 1 year. So a university builds a new business school building, or Ford builds a new plant to manufacture the F-150 truck, or McDonald's builds a new restaurant, tears down an old one and builds a new one in its place, whatever it might be. This is a purchase of a long-term resource, and these long-term resources are used to help the business do its operating activities. Now, as you may imagine, investing activities are often expensive. They require lots and lots of money. So where do we get the money in order to engage in our investing activities? That's our third type of activity. That's called financing activity. Financing activities are the receiving of cash from investors. And after we've made money and our investors would like to be paid back, we also can think of repaying our investors as a financing activity. So we generally think about investors in two types. Remember from the first video how important the concept of ownership was. One major important category of investors in a business is the owners of a business, and everybody else who's not an owner is non-owners, often called creditors, and synonymously called lenders. These are people who provide money to the business but don't have an ownership interest in the business. There are three types of activities: operating activities, investing activities, and financing activities. We will, of course, get into much more detail in these as we go throughout the semester. So how do we record all of these types of transactions in a clear, logical, and easy to follow format? Well, accountants have come up with a framework called the Basic Accounting Equation, and this is something that you're really going to have to know. Fortunately, it's pretty simple. The basic accounting equation is assets equals liabilities plus equity. Now, what does this mean? Assets are all the resources owned by a business. So we can think of a business owning lots of different types of resources. Businesses own cash. They have bank accounts that have cash in them. They have inventory. That's what the business has to sell. Imagine going into a store, Walmart or Kohl's or whatever it is, and you look around and you see all that inventory on the shelves and on the racks just waiting to be purchased. That's inventory that the business owns. We can think of supplies. So when you purchase your items at Walmart and you go and you get a receipt that comes out of the cash register, that receipt is printed on paper, and that paper was in the supplies. It's not something that Walmart is selling to you, but it's something Walmart uses in order to run its business. So that's an example of supplies. We can also think of the long-term resources that we got from our investing activities. Property, plant, and equipment is usually what it's called. And property, plant, and equipment would include things like the building that Walmart operates in, its fleet of trucks, its computer network that it uses to help determine which items should be restocked in what shelves. All the long-term things that Walmart uses for more than a year would be property, plant, and equipment. And we also have, as I mentioned before, non-physical or intangible assets. They're things that have some value to the business but are not something they can physically hold. So again, if somebody were to buy the Coca-Cola company, most of what they're getting is the goodwill associated with the name Coca-Cola. They might get a secret recipe, but what makes Coca-Cola valuable is not some particular stuff that it owns, but it's got the name Coca-Cola with all the history and the advertising behind it, and it's got its secret formula. There's not a lot of value there of stuff you can hold in your hands. It's all intangible value. So those are the kind of assets that Coca-Cola would have. So these are some examples. These are not all of the examples that there are. These are some examples of the types of resources that a business can own. So these are what assets are. Now the other side of the equation, the right-hand side of the equation, is liabilities and equity. In a sense, you can think of where the business got the money to get the resources. So where did Walmart get all the cash that it needed to buy its inventory and buy its buildings and that sort of thing? Well, we can think of, again, two different sources of cash or funding or financing for the business. Liabilities are amounts owed to creditors, non-owners of the business. So all the resources that the business owns, some of them were funded by amounts borrowed from non-owners. Equity is the residual or leftover claims by owners of the business. So in other words, of all the resources the business has, first the people who are non-owners have a claim to get paid off, and then whatever is left, the owners of the business have a claim to be paid off. I'll use a common example that doesn't necessarily come out of the business world, but it's something that many of us are pretty familiar with. So we may own a car, and let's say we go to the car dealership and we'd like to buy a car, and we find a nice 3 or 4 year old used car, and we decide we're going to pay $12,000 for the car. Now, how do we pay for the car? Well, by buying the car, we get an asset, but we might not have $12,000 in our pocket. We may be willing to put, for example, $3,000 as a down payment. That's money we didn't borrow from anybody else. And in order to make up the $9,000 difference, we have to take a loan from a bank or some other lender to make up the difference. So here we have a $12,000 asset. We've purchased the car for $12,000. $3,000 of it is our own money. We own that portion of the car, and the remaining $9,000 is an amount that we have borrowed. That works similarly for a house. You might buy a house for, $150,000, and you might put 10% down, and that would be your equity, and the remainder would be what you would have to borrow from the bank in your mortgage. That would be your liabilities. It's almost identical in concept, and certainly the analogy is very helpful. So assets, the things we own. Liabilities are amounts borrowed from non-owners, and equity is what the ownership interest is. And the equity ownership is, in a sense, left over. So, for example, let's say you bought this car for $12,000, and immediately something happened to it. You drove it off the lot and someone ran into it, and the car is now only worth $10,000. The bank is certainly not going to agree to take less money. You owe them $9,000. They want their $9,000. So in that case, your equity is left over, and that would be reduced to $1,000. This equation must always be in balance. Assets must always equal liabilities plus equity. If that doesn't happen, you have done the accounting incorrectly. That's reassuring in the sense that if you find yourself out of balance, you always know you've got somewhere to look to find an answer. So that's the basic accounting equation: assets equal liabilities plus equity. How is this accounting equation used? The basic accounting equation shows up in one of the primary financial statements. There are 4 financial statements that businesses generally report. The first one is really a statement of the basic accounting equation itself. It's called the balance sheet. And the balance sheet reports the assets, the liabilities, and the equity of a business at a particular point in time. So, for example, as of December 31st, 2013, what are the assets of a particular business, what are the liabilities that it owes to others, and how much equity do the owners have left over? The dollar amount of assets will always equal the dollar amount of liabilities plus the dollar amount of equity, because that's how the basic accounting equation works. The balance sheet is a report as of a particular point in time of the assets, liabilities, and equity. That's one of the basic financial statements. What it doesn't tell you, though, is it doesn't tell you anything that happened over a particular period of time, over a year, a month, a quarter, whatever it might be. So we have a variety of other financial statements, 3 others, that tell us what happened over a particular period of time. talked about operating activities. Operating activities are reported in what is called an income statement. Sometimes it's referred to by its old term, P&L, which stands for profit and loss. Particularly, you'll see older people who've been in business for a long time, and the term that's generally used by the people who generally use the term P&L, in my experience, are people who are a little bit older. So they'll use the term P&L for profit and loss. Sometimes you'll see it called a statement of operations. But basically, this reports the profitability or not profitability of the operations of a business over a period of time. Now, how do we measure the profitability? Well, if you think back to the operating activities, the first thing that a business does to generate its profit is it sells things to customers. And we call the measure of what has been sold to customers revenues. That's, in a sense, the inflow of value to a business from having sold things to customers. And it also incurs lots of activities to be able to sell things. It has to employ people, it has to rent space, it has to have inventory on hand, it has to advertise, it has to pay taxes, it has to have security, and whatever else goes into a business. So the activities that the business undertakes to generate revenues have expenses associated with them. And in a very simple sense, the profitability of a business is represented by its revenues minus expenses. And we call that the net income, which is synonymous with its profit. Now, there are lots of different sort of subtotals. We can talk about gross profit or gross margin and operating income and income before taxes and lots of sort of subtotals. But in a very simple sense, this is what an income statement is. Revenues minus expenses equals net income or profit. We've also talked about how important ownership is to a business. And so the third financial statement is a statement of owner's equity. And the statement of owner's equity reports the changes in owner's equity over time. In other words, how did the owner's claims to the resources change over a period of time? So we can think about the equity at the beginning of the year, plus changes, and of course throughout the semester we'll detail what these changes are, and that gives us changes at the end of the year. There are generally two types of owner's equity. The first is contributed capital. This is what the owners have put in, so checks they've written to the business in order to make their investment. And the second is earned capital. In other words, the profits that the business has earned over the period of time that the business has been in operation. Earned capital will be increased as the business earns more net income. So if the business earns a profit for the year, then the owners have a claim to that profit. It will be decreased if the business has net losses, that is, if their expenses exceed their net income. And it's also decreased by dividends. Dividends are when the business pays the profits back out to shareholders. So the beginning of the year earned capital plus these changes, adding net income or subtracting a net loss, and subtracting any dividends paid, gives the ending earned capital. The accounting term for this earned capital is retained earnings. It is the measure of earnings that have been retained over time and not distributed out as dividends. Contributed capital, again, is the amount that the business owners have put into the business to begin the business. And over the year, they may contribute more capital if the business needs more capital to run, or they may decide they don't want to have any capital, or they might decide they want less capital contributed, and it's conceivable that the business would distribute capital to them, not distributing their earnings, but distributing their capital back, and this would be their ending contributed capital. So the statement of owner's equity simply documents the changes over a period of time. We've got the beginning of the year, the changes, and the end of the year. The fourth financial statement demonstrates how important cash is to a business. Cash is the most important asset that a business owns. It's the one that's used to pay for everything that the business does, pretty much. It's also fairly easy for management to misuse because you can do pretty much anything with cash. So it's important for owners to know what has happened with cash, the most important asset, the easiest to misuse. So the statement of cash flows is a separate financial statement that simply just does what it describes. It shows the flows of cash. So we start with our beginning cash balance. Just like a bank statement, we add to it the increases in cash, and we subtract the decreases, and we end with our ending balance. For the year. Now you may have noticed that some of the things in these other financial statements are also similar to some things that are on the balance sheet. For example, our ending cash balance is what's going to show up on our ending balance sheet for the period because cash is one of the assets that we own. The equity that we have in the company is going to be reported in the equity section of our balance sheet. And the net income from our income statement is going to be reported in our statement of changes in owner's equity. So these things work together very closely. These four financial statements all work together to paint a picture of the transactions the business has undergone for the period and what its position is at the end of the period as summarized in its balance sheet.